If World War III breaks out, the stock market won't wait for you to react. It'll already be moving fast and aggressively. Trillions of dollars will shift direction before most people even realize what's happening. And right now, as global tensions explode, that shift has already begun. This is not some doomsday theory or abstract geopolitical fear. Israel's Operation Rising Lion has already hit Iranian nuclear sites. Oil is exploding higher, gold just broke through new highs, and defense stocks are charging like it's the opening of a global arms race. But this is just the tip of the iceberg. Beneath the surface, smart money is quietly loading up on assets that thrive during global crises before the mainstream catches on. In today's video, I'll walk you through the sectors and specific stocks that could be the biggest winners if the world heads deeper into conflict. I'm talking government-funded defense giants, nuclear disruptors rewriting energy strategy, and hard asset commodities becoming global safe havens. Also, don't forget to smash that subscribe button if you want to stay ahead of the market when everyone else is still stuck reacting. Operation Rising Lion reignited global defense spending with speed we haven't seen in decades. Raytheon shot up over 3% just hours after the initial strikes. Lockheed Martin jumped 4% as global air defense interests surged. L3Harris and Northrop Grumman followed closely. These aren't just temporary spikes. They reflect a growing shift in budget priorities from every NATO nation and regional power. It's not just the big names. The iShares US Aerospace and Defense ETF ITA just broke out of multi-month consolidation with volume confirming the breakout. Inside ITA, we're seeing momentum flood into names like Rocket Lab, Archer Aviation, and Exxon, which are bringing real innovation into combat zones. Archer just announced further collaboration with DoD teams on autonomous air logistics. This isn't speculative anymore. And look globally. India's Hindustan Aeronautics saw a nearly 8% jump in a single day as global funds seek military exposure across continents. This is not a local rotation. It's a coordinated reallocation of capital into wartime logistics. While the spotlight remained on missiles and jets, Oklo stunned the energy world by locking in a real Department of Defense contract. Not a test, not a prototype, a deployed SMR unit headed to Eielson Air Force Base in Alaska. This marks the beginning of battlefield-ready energy infrastructure. The market response? Immediate. Oklo stock exploded nearly 30% in just 2 sessions. Wedbush upgraded its price target from $55 to $75, citing the move as a massive strategic pivot in national energy security. This isn't just about military usage, it's about enabling decentralized, mobile, hardened power sources across critical zones. Nuclear isn't stopping there. NuScale and Cameco are both gaining steam. The uranium supply chain is waking up as demand forecasts get revised higher. ETFs like URNM and NLR are climbing with renewed investor flow. In a world where oil routes may be bombed and pipelines sabotaged, nuclear is positioning as the ultimate independence play. Brent crude is projected to rise above $90. The Strait of Hormuz, where nearly 20% of the world's oil flows, is a choke point and a real threat. Even whispers of escalation send oil markets into a frenzy. That's not going away. ExxonMobil and Chevron are benefiting directly. Pipeline players like Enterprise Products Partners are experiencing renewed investor confidence. These are not short-term spikes, they are realignments of global energy strategy. And gold? It just passed $3,400, absorbing fear, inflation, and demand for hard safety. Miners like Barrick Gold and Newmont saw institutional call option spikes. When war looms, paper assets take a back seat. Tangible stores of value rise. Shipping companies are also being repriced. BWET, BDRY, and others tied to freight logistics are rallying as rerouting drives up insurance and delivery premiums. This is the supply chain pivot everyone missed. While mainstream investors are still watching headlines, institutional capital is moving with purpose. Defense, energy security, hard assets, and in all that movement, one market is absorbing a flood of global money. Not because of war, but because of what war does to everything else. Let's go back to the stocks driving this wave. Lockheed Martin is still trading below its all-time high, and with order pipelines expanding, this is a lagging leader with clear tailwinds. Raytheon's backlog is reaching new levels. and its role in international defense alliances only adds to the thesis. Oklo's re-rating isn't priced in fully yet. A single deployment is big, but the Department of Energy has expressed deeper interest in modular resilience, especially in remote areas and emergency bases. This could go from one contract to an entire grid strategy. Oil has structural support. Even if prices cool, companies like ExxonMobil have the upstream stability and war hedging that investors are looking for. Same goes for gold. The price action suggests institutions are preparing for longer-term uncertainty, not just a flash panic. Markets don't wait for press conferences. By the time war headlines hit, capital has already rotated. That's what makes this so critical right now. The reallocation into defense, uranium, oil and gold is happening in front of us. Passive portfolios won't protect you here. Strategic allocation will. Look at where the inflows are going and watch how ETFs rebalance. The edge isn't in prediction, it's in preparation. Here's something few are talking about. Global wealth is quietly rotating into Switzerland. Neutrality, strong currency policy, strict banking secrecy laws, and no exposure to NATO or major defense entanglements are making it the quiet winner of conflict-driven capital flight. Swiss equities are gaining interest, and their financial sector is becoming a silent haven. If major sanctions spread or cross-border capital restrictions intensify, funds will seek out safe jurisdictions. Switzerland is positioning as that vault. Just a quick shout out to our sponsor, Moomoo Financial. If you're looking to start investing or expand your portfolio, Moomoo has an incredible offer just for you. When you open a brokerage account using the link in the description and deposit as little as $1, you'll get a chance to draw a free stock, and that stock could be worth up to $2,000. But that's just the beginning. If you make a net deposit of $100 or more, Moomoo will reward you with 5 free stocks, each potentially valued at up to $2,000. That's a huge opportunity to kickstart your investing journey with minimal effort. And if you're ready to go all in, depositing $1,000 or more unlocks an even bigger reward, 15 free stocks. That means you could be looking at a total value of up to $30,000 in free stocks just by getting started. This is one of the best deals out there for new investors, and it's a great way to explore the stock market with zero commission trading, advanced tools, and a user-friendly platform. So, don't miss out. Click the link in the description, sign up, and grab those free stocks while this offer lasts. Now, let's jump right back into the video. Volatility is only dangerous when you're unprepared. These sectors, defense, nuclear, oil, gold, and safe banking, are where the disciplined capital is parking. You don't have to guess the headlines. You just need to understand the map that institutional money is following. Options, sector rotation, and staggered entries can all protect downside while keeping exposure to upside events. This is not panic territory. It's opportunity with a sharper lens. World War III might feel like a worst-case scenario, but markets are built on positioning, not panic. The smart capital is already ahead. From defense and nuclear to gold and oil, we're seeing clear signals of preparation, not reaction. If you want to stay sharp in this environment, now is the time to act. Make sure you're not stuck in lagging sectors when the next headlines hit. Subscribe, leave a comment, and drop your thoughts below. How are you positioning in these markets?